Investing in stocks is something that many people are drawn to. However, understanding the difference between US stocks, international stocks, and emerging market stocks can be more confusing. Today, we will explore the differences between these investments. So Spencer, we're going to start today with some familiar ground. We're going to talk about US stocks first, but for each of these categories, US, international, emerging, we'll be talking about their characteristics, benefits, challenges. So in layman's terms, talk us through, what are US stocks?
So US stocks are stocks of companies that are domiciled in the United States. And it's always funny when we have someone say, well, I want to invest in the stock market. There's a lot of stocks and they're traded on a lot of different markets. And so we have to distinguish, where is a company domiciled, where are their operations, but not just where are their headquarters, also where do they have their fingerprints all over the globe? Because you could be a US stock that actually has the majority of your revenue coming from around the world, or vice versa, you could have a company that is domiciled in Europe that has most of its operations in the United States, but for whatever reason, they're still, their headquarters are in the UK or wherever it might be. So we need to distinguish there, and the United States has the most robust financial system, the markets that are, kind of the world's envy, really there. So we tend to make it easy for companies to set up here, to have their operations here. There are filings, of course, that have to be done. But the difference between a US stock, an international developed stock, and an emerging market stock is simply where they're domiciled. So again, US stocks here, international developed stocks, that would be stocks that are companies that are set up, that are domiciled in Europe, in Japan, in Canada, in Australia, in these countries that they generally enjoy the same standard of living, roughly, that the United States has. They're developed markets. They're not the emerging markets, which the emerging markets would be China, Brazil, India, Indonesia, Mexico, a lot of these countries that their financial markets have not kind of gotten to that level where they're as developed, they're as built out, and where the standard of living for their citizens isn't the same as what we would find in Europe and the United States.
Right. Okay, so talk us through some of the benefits and challenges of US stocks.
So when we look at US stocks versus international stocks or emerging market stocks in particular, I'm not sure that I would say it's an advantage or a disadvantage, but there are different sectors that are involved. Now, every country is probably going to have some level of technology stock. Every country is probably going to have some financial stocks in the developed world. But when we look at the weighting of it, the United States stocks as a whole have more on the tech side than their international or emerging market counterparts. So we have more of our value in companies like Apple or Google or NVIDIA or others that are out there that are skewed toward that arena, whereas the emerging markets would have almost twice the value on a percentage basis in financial stocks that the United States would. I think the financial stocks in the United States as a sector are something like 12 or 13%. It's about double that in the emerging markets. That's not to say that the emerging markets have more value. Actually, if you took all of their financial companies and put them together, it still probably wouldn't equal the value that we find in the United States financial stocks. But as a percentage of their stock market, it is a higher percentage there. Particularly when we look at Europe, when we look at Japan, Europe, and the international developed markets outside the United States, you'll notice that there are far fewer tech companies there that are represented. They have more in industrials. They have more in financial sector by a percentage, again, than we do in the United States. So it's not just a one-size-fits-all, hey, we need to, you invest in US stocks and they're going to be identical to emerging market stocks or international stocks. There's a lot of differences, there as we look at those.
Right. So talk us through some more benefits of US stocks, Spencer.
Well, I mean, we have a level of national security that is different than what we see in Europe or other parts of the world. We have oceans on either side of us. We have good relationships, generally speaking, with Canada and Mexico. So we're not in a situation where we have an adversarial relationship, say we're Japan and we're concerned about China, or we are India and we're also concerned about China, or we're China and we're concerned about any of these other parties around us. There's a level of insulation. there that whether it's just a perceived benefit or an actual benefit, we'll see. But investing in U.S. stocks, there is a premium, some based on the financial system itself, but also some based, I think, on the strength of the military overall to be able to defend those assets. I think in particular. So as we look at that, the U.S. stock market on the flip side, it has been more expensive than international stocks or emerging market stocks. The price to U.S. stocks overall relative to the earnings of U.S. companies has been more expensive than their international and emerging market counterparts for some time. So you're paying really a premium there for that perceived level of security.
Yeah, that's good. Okay, so let's move on to international stocks. So we're going to particularly start off with those developed markets. So companies that are domiciled, headquartered outside the United States. What are some key things that we need to know about international stocks and their characteristics?
Well, it's good to diversify. I mean, that's one of the principles that I think any financial advisor would come back to, is diversification is helpful in terms of building out portfolios, because we don't know if we end up with some kind of government that may not be as friendly towards business, or we end up with some kind of calamity, in the United States versus other parts of the world. So being able to diversify investments instead of across maybe 3,000 companies in the United States, could be 10,000 companies globally. That level of diversification is nice, really, to look at. As I mentioned, there are different sectors and different weightings. There's just different companies and ways that they're run that can be good for diversification. As well, the currencies of these countries comes into play, and that can actually be positive. We are doing a great job in running up our federal deficit. If there's one thing that we're good at, it seems to be spending money, spending more than we bring in, at a federal level. So that can contribute to a weaker currency. So if we diversify with investments around the world, if the US dollar should weaken substantially over time because we run a trade deficit and we're printing a lot of money as a government, then that can be helpful to have diversified assets that perhaps we have investments in companies that are domiciled in places that aren't running such a significant deficit there.
Yeah. Okay, so what are maybe some benefits and challenges then, additional to what you've already suggested, for international stocks?
Well, I think one of the things is because they are less expensive right now on a price to earnings basis, there are a lot of commentators that are out there who feel that international stocks and emerging market stocks are positioned well for long-term growth. That, who knows whether that will happen over the next 5 to 10 years. But certainly there are some attractive valuations relative to their U.S. counterparts.
So what about different challenges? What are some challenges that international stocks face?
Well, historically, international stocks have generally been a little bit more volatile than U.S. stocks. And one of the reasons is that you have a currency component in there. So you have the ups and downs that you would typically have in the stock market, but then that can be increased in a small way by currency movements there as well. So international stocks have tended to be a little bit more volatile than their U.S. counterparts over a long period of time. The other thing that is good in some ways, in that it diversifies our holdings with different currencies. At the same time, that can create challenges there, because even if we have a strong company that's well run and it's let's just say it's headquartered in France or in the UK or some other part of the world, if it's really well run but the currency gets crushed of the home country there, that can have an impact certainly on the stock price and what the price that we could garner for that company. Essentially, even if we're not investing directly in that market, if it's through an ETF or a mutual fund or what have you, there's still a corresponding valuation there of those companies, and some of it can be driven by currency effects.
Right. Okay, so let's shift now to emerging markets. What do we need to know about emerging market stocks?
Emerging market stocks are interesting in that these companies, they're domiciled in parts of the world that their financial systems are not as robust. This level of disclosure is not as high as what we would find in the United States. Now, there are commentators that talk about how U.S. companies are making too much money and there's not a level of disclosure and you're not thinking about other stakeholders and such. And all of that may be true on some level. However, compared to the rest of the world, the level of disclosure is quite high. So when we think about emerging market stocks in particular, and I'll point to Chinese stocks, there are Chinese stocks that are mostly owned and controlled by state entities. And so as you think about that, the level of disclosure is not going to be as high. You can't trust necessarily what their operations or even their books are at quite that same level. Now, they could be great investments and everything could be above board, but there have been enough incidents there and enough challenges with the financial system that I think everyone looks at that and is not quite as sure of what's being reported there. The other thing is that I think for investors to understand is the way companies operate in these other parts of the world is not going to necessarily be consistent with the way that we operate in the United States. So if you have concerns about how workers would be treated, if you have concerns about the environment, if you have concerns about the overall governance of companies, in the emerging markets, you need to really think about the companies that you invest in a much deeper way, because we don't have that same level of transparency. In the United States, it's fairly easy to divine what's happening with a company, where they may be engaged in practices that you might find objectionable, and kind of to steer clear. Much more difficult to do that in the emerging world. And, whether we're talking about using a subset of the population that you don't like, say the Chinese using Uyghurs to in slave camps to do some of their bidding with respect to companies producing things and such like that. Or if we're looking at countries, say in Africa, where they're getting certain commodities or goods in areas that are not traced well. We really need to understand that a stock, an investment that's made, you're an equity owner and you need to be comfortable with whatever the company is doing there, because there are a lot of layers there between what that company is doing and then what the reporting will be to you in the emerging world in particular. In the United States, there are plenty of groups that will hold a company's feet to the fire if they are using slave labor, for instance, in Africa to harvest chocolate or something like that. Not so much in the emerging world.
Right. Okay. So we kind of talked a little bit of the challenges with the opaque nature, some of those things. What are some of the benefits of emerging market stocks?
Well, in the emerging world, the economy is growing at a much higher clip than what we see in the United States. So you think about economic growth, really, and it boils down to two things. How many people do you have in your workforce, and how productive is your workforce? In the United States, our workforce has basically been stabilized the last few years. The only additions to our workforce are immigration, really, at this point, because our replacement rate, our birth rate has fallen, and we're kind of in that steady state unless we have immigration. In Europe, it's even worse. In Japan, it's even worse. So that birth rate has fallen a whole lot more. So without substantial immigration in those areas, you're not going to have a population increase. And so you have to have productivity gains that at least offset that. So your economy is probably not going to be growing much at all, if it is any, in kind of these developed areas of the world. Whereas when we look at India, when we look at Africa, when we look at Indonesia, when we look at Mexico, a lot of these other countries, their population is still growing, and of course their productivity is growing like gangbusters too, because they're coming off of not having a very productive workforce compared to the United States. Again, if you're paying people $8,000 a year versus paying people $50,000 a year, on average, then the productivity gains that you can have are pretty substantial in there if you just adopt some new technology there overall. So a growing economy, growing profitability potentially, a lot of opportunity set as well with cheap companies. The last few years, emerging market stocks, their price to earnings, their price to book ratios have been far south of what we've seen in the United States. And so people say, well, if I can invest in something that's less expensive and is growing, the economy is growing at a quicker rate, that sounds like it could be a nice pairing there.
Right. Well, thanks for walking us through the basics there, Spencer. Let's touch on two more topics. We'll talk about how to access these investments and then their tax implications. So Walk us through, because emerging market stocks, how do I find a company, or is it just not worth it to look for a company? Are there different ways that we can have access to these investments?
Well, most investors are not going to invest in individual stocks to begin with. It does become more of a challenge to invest in a broad basket of emerging market stocks, for instance, because we don't have these by and large, we don't have the bulk of them listed, say, on the United States Stock Exchange exchanges. So when we think about that, usually investors are going to access those through a mutual fund or an exchange-traded fund, maybe that focuses on that part of the world, or invest in that part of the world as a broader set of investments. So it could be a global stock fund that has 10% of it in the emerging markets and 30% of it in the developed world outside the US, and then 60% in US stocks, and that wouldn't be too far from, say, the market capitalization, levels that we see in those respective areas. So access tends to be through a mutual fund, an ETF, rather than, say, investing in that individual company directly.
Yeah. Okay. So let's talk taxation, because the tax implications are a little bit different for each of these. So talk us through, how do we think about taxes for a non-qualified account for each of these? Yeah.
So taxes are interesting, and you can't really speak to each particular situation because the United States has many different tax treaties with many different countries, and sometimes they're uneven in different ways. Generally speaking, of course, if you have an investment that's in a U.S. company and you have a non-qualified account, then if the company pays a dividend and you've abided by certain laws for holding periods and such, it's a qualified dividend. And what happens then is that your rate of taxation is similar to long-term capital gains under current tax law. So it's a preferential level of taxation for the dividend distribution that's made, similar again to long-term capital gains. If we have short-term capital gains, of course, then it's taxed as ordinary income, and we've got some other considerations typically there. If we look at international stocks, though, oftentimes what happens is there's a level of taxation that's going to happen of withholding that's actually going to be in the country where the stock is domiciled. So if we invest in a company XYZ and they pay out a dividend, then there's going to be a withholding that's made by that foreign government for that dividend. Now, there's an offset that U.S. investors get if there's a tax treaty. So for most of Europe, we have tax treaties in place where you say, okay, well, if we've got $5,000 of tax that's withheld for this particular investment, over in Europe, there's a credit, that's provided for us on this side of things, so that we're not paying double taxation. But there are countries where we don't have that tax treaty, and so you could imagine if there's taxes withheld, but we don't have a tax treaty, then you could end up with double taxation there. The other thing to note is that within IRA and Roth IRA, there can still be that tax withheld on one side, but there's not a credit that's offered on the other side in certain circumstances. So have to be careful about that as well, because it can be kind of a one-way street there with those qualified investments where we're not getting that kickback benefit of a tax credit on the other side of things. So lots to consider there. Generally speaking, because the United States is running a trade deficit, and because we are running a fiscal deficit, it's likely, given general economic principles, that our currency will devalue against a broad basket of other currencies. So it may be that we pay a little bit more in tax, for these investments in certain circumstances. At the same time, it could be that the long-term direction of where the U.S. dollar will probably go could be an offset, therefore. So lots of different factors to consider, but the key drivers, again, would be diversification and making sure that we understand the ups and downs that may be introduced with those international stocks.
Great. Okay, so for investors, there is going to be a wide array of allocations that you could put towards US, international, and emerging markets. We are not going to say this is the percent for anybody. So Clients, if you want to talk about emerging market stocks, international stocks, US stocks with us, the allocation that you have, the allocation that you think you should have, we would love to have that conversation with you. Feel free to leave questions in the comments below, and we'll see you again next time. If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at seriousretirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at seriousretirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.